Hi, and welcome to Chapter 13, Written Problems to Study. So if you haven't already, go ahead and print out this spreadsheet. You can go ahead and do 13 and click on the 14 sheet and click print out both of those. And if you'd rather work in Excel, open up a blank sheet, enable editing, and go ahead and journalize these transactions. If you are not sure about one, look it up in the textbook or in the PowerPoints or in your notes and journalize it. And if you're still not sure, go ahead and journalize it the best that you can. So even if you're not completely sure about your answer, go ahead and put down something. Pause this video, and then when you come back, check your work to what I've done. Okay, let's do Chapter 13 first. So it says, journalize the following transactions. Issued 1,000 shares of $5 par common stock at $25 for cash. So we'll just put in letter A since they didn't give us a date. That'll be our date. It'll just be letter A. And we received cash. And the way that we calculate how much cash is, it says that we issued 1,000 shares at $25 for cash. So it's going to be 1,000 times 25. So that's 25,000. And then we always put common stock at the par value. So we're going to credit common stock because it's a capital account, so it has a normal credit balance. And that's going to be at par value. So it'll be 1,000 times $5. So that's $5,000. Anything in excess of that par value is going to go to paid in capital in excess of par. And we can put common stock. And that is just the remaining. So we will subtract 25,000 minus 5,000, and we get $20,000. Looking at letter B, purchased 1,000 shares of treasury stock for $30 per share. So whenever we purchase something, we know we're going to be paying out cash. So what are we getting? Well, we're getting treasury stock, which has a negative impact on capital. So instead of having a credit balance, it has a debit balance. And we purchased 1,000 at $30, so 1,000 times 30. And we paid cash for this. So we're going to credit cash for the same $30,000. In treasury stock, we don't care about par value. In letter C, we sold the 1,000 shares from letter B for $40 per share. So what we know is that if we sold something, that means that we get cash, and it tells us that we got $30 per share. So we'll say 1,000 times $40 because that's how much we sold it for. And then we need to show that we no longer have that treasury stock, so we're going to reduce our treasury stock with the credit, and we need to do that for the same amount that we originally paid. So look back at B, and we originally paid $30, so we'll say 1,000 times 30 again, which we know is 30,000. So we say equals 1,000 shares times $30. I don't know why my keyboard is not cooperating. I think it's my fingers. Okay, so that's 30,000. And the difference between what we got and what we originally paid for this treasury stock is going to be called paid in capital from treasury stock. So paid in capital from sale of treasury stock. And that's 40 minus 30, which is going to be 10,000. And that's how we do treasury stock. Letter D says, journalize the following two entries. Declared cash dividends of $10,000 on January 1, so that's our date of declaration, and paid the dividends on January 30th. So we have a date, so we'll put it in here. So January 1, we declared those dividends. That's when we set up that liability. So we'll say cash dividends, and that has a normal debit balance just like drawings did. And then we will say cash dividends payable. And they tell us the amount. It was $10,000. Then on January the 30th, we actually paid those. So we're going to get rid of that liability. And so we're going to debit our liability. So we debit cash dividends payable. And we're going to credit cash because we used cash to pay it. $10,000. Okay, and that is all the ones for Chapter 13. So go ahead and look at Chapter 14, and again, work them out, look up anything you're not sure about, and then anything you're still not sure about, go ahead and write down something, because it'll make a lot more sense even if you got it wrong when you look at the right answer. So pause it and then come back to see the right answers. All right, number 1. On the first day of the year, CRT Company issued 1,008% 10-year bonds for $1,700,000. And with the interest payable semi-annually, journalize the following transactions for the current fiscal year. So we have the issuance of the bonds. So all we have is letter A, so we'll call it letter A. And we received cash. And how much did we receive? It says that the bonds issued were 1 million bonds. That's the face value. And so the amount that we actually received was 1,007,000. So we can see that we received more. So that's going to be a premium. All right, and then we have bonds payable. We always pay back the face value of those bonds. And so we're going to be paying back, what happened to my debit? We're going to be paying back the 1 million. So we look and we see that we need a credit to balance, and so that's going to be a premium, right? And so premium is going to be for the difference, which is $700,000. And we'll call that premium on bonds payable, or just premium. All right, letter B says that we've made the semi-annual interest payment in the amortization of the premium. So we know that when we do this journal entry, we're going to show interest expense, which is made up of both the cash paid and the amortization of the premium, which we'll subtract from it. And then we need to get rid of the premium, so we'll need to be debiting our premium account. And then we'll be needing to credit our cash. So let's start with cash because that's the easiest. We always pay cash interest by face value times contract interest rate times time. So my face value is 1 million. Then my contract interest rate is the 8%, 0.08, and then my time is 6/12 because it's semi-annual. So I'm going to pay out $40,000. That's part of my interest expense, but I've got something else to do first. I need to amortize my premium. So my premium was $700,000. I need to divide that by the total periods. All right, so I'm going to be debiting my premium to amortize it. So $700,000 divided by 20 periods. I debit it because I'm getting rid of that premium balance. That's $35,000. So how to get to interest expense? In order to balance, I need to say $40,000 minus $35,000. So that's $40,000 minus $35,000. So $5,000. So I can see that my interest expense went down by premium, which is what a premium does to interest expense. It reduces it. Repayment of bond at maturity. So I need to pay off this $1 million bond. So I'm going to pay off the face value, bonds payable, and I use cash to do that. Its face value was $1 million. The next one, which is number 2, is early redemption of the bond. A $10,000 bond with unamortized discount of $2,000 was redeemed for $6,000. Journalize the early redemption of the bond. Well, I know I need to clean up 2 accounts and recognize 2 accounts. So I'm going to clean up bonds payable. I'm going to make that balance be 0. It had $10,000 in it. It was a credit, so now I'm going to debit it to get rid of it, so $10,000. I would like to get rid of the amount in my discount account. And to get rid of a discount, it has a normal debit balance, so to get rid of it, I credit it. So I'm going to credit discount for $2,000. It has to tell me how much I need to pay for this. So my cash that I had to pay off this bond was $6,000. So at this point I need to look and see what is my carrying value. Well, I have a bonds payable and discount reduces that. So bonds payable minus a discount would be $8,000, and I only had to pay out $6,000 in order to pay it off. So that's a gain. So I need a credit to balance. That would also tell me that it's a gain. and I need $2,000 to balance. So now I'm in balance. 6, 7, 8, 9, 10 equals 10. So this is early redemption of the bond. So let me know if you have any questions, and let me know how that went. Thanks.